Welcome back to another deep dive. I'm Liam, and today we're cutting straight through the noise. The big question right now isn't whether foreign direct investment, or FDI, is flowing into Vietnam. We all know it is. The real question is which companies actually have the right land, the right location, and the right infrastructure to capture that capital. Today, we're tearing apart the hype surrounding industrial real estate. Let's get into it.
You see the headlines literally everywhere, right? FDI is flooding Vietnam. It's so easy to get caught up in the FOMO and just assume that any company with the words industrial park in its name is going to see its stocks skyrocket. But here is the harsh reality. A macro trend only turns into actual profit if a company has the fundamentals to absorb it. So we shouldn't be asking if the capital is coming. We need to be asking who actually holds the clean land, the clear legal status, and the infrastructure to welcome these giants right now.
We've got a lot of ground to cover today. We're looking at the macro drivers pushing the shift, the massive new standards for next-gen industrial parks, the ultimate infrastructure moat, the top beneficiaries, specifically BCM and SEZ, and finally, the criteria you need to pick winners, along with the risks that could absolutely tank your portfolio.
All right, let's kick things off with the macro picture, the X+1 shift.
So you've definitely heard of the China plus one strategy, right? Well, that's evolving into a much broader X+1 approach. Global heavyweights like Apple, Samsung, Intel, and Foxconn are actively hunting for safe havens to de-risk their supply chains. And the ongoing U.S. tariffs on Chinese exports, that's just pouring gasoline on the fire. So why Vietnam? It's simple. We've got the geographic advantage right next door to China's tech hubs, a massive network of free trade agreements like the EVFTA, CPTPP, and RCEP, and labor costs that are still incredibly competitive. Vietnam isn't just the cheap alternative anymore, it's an absolutely crucial strategic link.
But here's where we really need to upgrade our investment mindset. The very nature of this FDI is changing. The old era of FDI was all about cheap labor, textiles, and basic assembly. Now, it's a totally different ballgame. We're talking high-tech, semiconductors, data centers, AI, and advanced electronics. And this new wave of capital requires fundamentally different infrastructure. You can't just pave over an empty dirt lot and expect a massive tech giant to sign a lease. It just doesn't work that way anymore.
Which brings us to the incredibly strict standards of next-generation industrial parks.
Look at this number. Vietnam's national target is to build a $16.5 billion semiconductor industry by 2030. To attract that level of high-tech manufacturing, industrial parks are in a ruthless race to upgrade. Think about it. A semiconductor fab cannot tolerate a power flicker that lasts even a fraction of a millisecond. They demand a flawless power grid, ultra-clean water, and highly specialized, ESG-compliant waste management systems. If a park doesn't have that, it's immediately out of the running.
And it's the exact same story with data centers. The country is targeting 950 megawatts of data center capacity by 2030. Data centers are the new gold mine for industrial real estate, but they eat up massive land banks and need incredible security, top-tier energy resilience, and premium broadband fiber. If a developer isn't already laying the groundwork for these specs, they are going to be left in the dust.
Let's move on to the infrastructure moat. This is where the capital truly anchors down.
Massive public investments are literally redrawing the industrial map of Vietnam. We're talking about Phase 1 of the Long Ton International Airport with a 114.5 trillion VND budget and the deepwater logistics hub at Khai Map Thi Vai. Industrial parks that sit right next to the North-South Expressway, Ring Road 3, Ring Road 4, or these major ports, they possess an impenetrable economic moat. This infrastructure slashes logistics costs for tenants and opens up Tier 2 provinces, making them the premier choice for high-quality FDI.
So let's get micro. Who actually benefits from all this? Up north, you've got KBC, VGC, and IDC catching the tech and semiconductor wave. Down south, it's SIP, LHG, NTC, and GVR hugging the logistics hubs. But to really understand the mechanics, we're going to put two prime examples under the microscope today. Become XIDC, ticker BCM, and Sona DZ Chow Duck, ticker SEZ.
Let's look at Bechemex IDC first. BCM is an absolute giant in the south. They've practically shaped the entire industrial landscape of Binh Duong province with their highly effective industrial park plus urban area model. They've got a dominating moat with nearly 900 hectares of commercial land ready to do. And just look at the strategic location of their expansion parks, like Bao Bong and Kai Trong. They sit right on major national highways, plugging directly into Ho Chi Minh City, Cat Lai Port, and Tan Son Nhut Airport.
When a multinational is looking for massive scale and a fully integrated ecosystem, BCM is almost always their first stop. Then we have Sonazisi Chow Duk, SZC. This is a textbook example of right place, right time with exactly the right preparation. SCC sits perfectly at the intersection of the Bianhua-Vung Tau Expressway and Route 991B. But more importantly, in a market that's absolutely starving for supply, SCC is sitting on a massive 500-hectare clean land bank that is ready to lease immediately. And it's incredibly close to the LIEMPT Vai deepwater port and the future Langfang Airport.
And the hard data totally backs this up. We recently saw a massive 84% jump in SCC's short-term prepayments, hitting 655 billion VND. Let me be clear, this isn't speculative money. This is driven by tech heavyweights like Tripod Technology, one of the world's largest printed circuit board makers, taking up a huge chunk of that space. This is what high-tech FDI looks like in real life, locking down prime real estate right now.
Now pay close attention here, because this is the CFA-level insight that separates retail traders from institutional money. If you look at SCZ's 2026 business plan, you might panic seeing their target accounting profit drop, but it's an illusion. It's caused by Circular 99/2025, a new accounting rule that forces companies to amortize land lease revenue over the life of the contract, rather than booking it all at once. It's just a paper loss. The reality, their actual cash flow from these leases is projected to skyrocket by 75%, surpassing 910 billion VND in 2026. Big capital doesn't care about accounting quirks. It cares about real cash flow. Don't let a change in accounting standards shake you out of a fundamentally rock-solid asset.
Let's shift gears to the actionable stuff, selection criteria and the major risks.
If you're evaluating an industrial real estate play, they absolutely must hit these 5 criteria. 1. Do they actually have a clean land bank ready to lease, or is it just lines drawn on a map? 2. Are they right next to a deepwater port or a major highway? 3. Is their legal status crystal clear for immediate handover? 4. Do they have the capability to offer ready-built factories, ready-built warehouses, or custom build-to-suit options for clients who need to move fast? And 5. Are they ESG compliant? Remember, giants like Apple and Samsung mandate solar power and circular water systems. If a park isn't green, the big guys aren't even knocking on the door.
But we have to stay objective here. There are severe risks out there for unprepared companies. Legal and land clearance delays can literally trap capital for years. Power and water shortages, that's an instant death sentence for high-tech manufacturing. Plus, compensation costs are going to jump significantly under the 2024 land law, which will crush the margins of developers who haven't secured their land yet. And let's not forget the fierce competition from places like Indonesia, Malaysia, and India. Just because a company has land doesn't mean they have clean land ready to lease right now.
So what's our core takeaway today? Capital doesn't flow to the cheapest land. It flows to clean legality, superior infrastructure, strategic logistics, and the ability to get global investors up and running as fast as humanly possible. We are entering a market cycle that rewards deep, fundamental quality over surface-level quantity.
I've laid out the key drivers, the criteria, the stocks to watch up north and down south, and the real risks to keep an eye on. Don't just read the FDI headlines and chase the hype. You have to look at the real story behind the land banks, the infrastructure, and the actual cash flow, because that is where the real investment opportunity begins. So take a hard look at your portfolio. Does the industrial real estate stock you own actually have clean land, or are you just holding on to paper promises? Thanks for tuning in, and I'll catch you in the next deep dive.